On a cold morning in South Bend, Indiana, in 1963, Studebaker workers showed up like always, believing the pension promise was real. A few months later, the plant closed and that guaranteed future turned into a fraction. Loyalty didn't protect them. My name is Tom, and I spend way too much time thinking about retirement, math, and the psychology of money. If you're working past 59 because you're not sure you can stop, subscribe and like this video. It will help more than you think. By the end of this video, you'll understand the exact pattern that turns 1 more year into 5 more years, and who profits from your delay. And we're gonna start by going back to South Bend. Look, here's the thing. When someone is working past 59, everyone around them tends to react in one of 2 dumb ways. Way number 1 is the polite lie. Good for you, staying active. As if the only reason a 62-year-old is still taking meetings is because he's addicted to spreadsheets. Way number 2 is the judgment. Why didn't you plan better? As if every life goes according to plan. As if layoffs, divorces, medical bills, and the price of everything in America didn't do a coordinated group project to wreck people. Both reactions miss what's actually happening. Most people working past 59 are not doing it because they love the job. They're doing it because they are negotiating with fear. And fear is a terrible financial advisor. And to be fair, the fear has data behind it. In the United States, the typical household nearing retirement does not have a giant pile of money. Depending on the survey, the median retirement account balance for people in their late 50s and early 60s is often under $200,000. And roughly 4 in 10 working age adults have no retirement account at all. So yes, for a lot of people, the runway is shorter than they want to admit. And the weird part is, even people who are objectively doing fine financially still feel like they're not allowed to stop. That's not an accident. That feeling is engineered. Let me give you a number that should make you uncomfortable. If you're around 60, you might have something like 1,000-ish healthy weeks left. Not total weeks alive. Healthy weeks where your body still listens, where you can walk without calculating how far the parking lot is, where your brain doesn't get foggy at 2 in the afternoon, where you can get on a plane without needing 2 days to recover. 1,000 weeks sounds like a lot until you translate it into life. That's roughly a couple dozen summers, a couple dozen Christmas mornings, a limited number of my knees still work hikes. And here's the brutal part. You don't get to buy those weeks back later with money. Now you might be thinking, okay, Tom, that's dramatic, but I don't have a choice. I have to work. The math doesn't work. Sometimes you're right. Some people truly need the income. And if that's you, I'm not here to shame you. I'm here to make sure you don't get played while you're doing it. But a lot of the time, the math doesn't work is not actually math. It's uncertainty. It's lack of clarity. It's the feeling of being 1 bad year away from disaster, even when the numbers say you're not. This is where it gets really interesting. Because that feeling is profitable for other people. So let's separate 2 very different situations. Situation 1, you do not have enough money to retire with safety. Situation 2, you have enough, but you don't feel like you have enough. Those sound similar? They are not. In fact, there's a famous pattern in retirement research where even very wealthy people report feeling insecure. One major survey asked high net worth households how secure they felt, and many of them said they would need roughly twice what they already had to feel comfortable. Twice. Let that sink in. If a man has $5 million, he thinks he needs 10. If he has 10, he thinks he needs 20. The finish line moves because the finish line is not a number, it's a feeling, and financial products are sold to feelings. Now, before we go any further, I want to challenge a common assumption early, because this is the assumption that quietly ruins people in their 60s. The assumption is, working longer is always the safest plan. Sometimes working longer helps, sure. More income, more contributions, more time for markets to recover. But sometimes working longer is the trap. Because working longer can become a substitute for making a real plan. It can become a way to avoid decisions. It can become a way to keep the fear quiet for another year. And the most dangerous part is this: the year you trade away might not be a normal year. It might be one of the last good years. So here's what we're gonna do. We're gonna talk about the math, but we're gonna talk about the kind of math people never do because it's uncomfortable. The math of time, the math of risk, the math of fees, the math of what one more year actually buys you after taxes, after commuting, after stress, after your body starts sending warning signs. And then we're gonna talk about psychology. Because if math alone solved this, everyone with a calculator would be free. Let's start with a simple truth that most people never say out loud. After 59, money is no longer your scarcest resource. Time is. And that changes the rules. Think about how you make decisions when you're 25. You have plenty of time. You can screw up, recover, start over. Time is abundant. Money is scarce. Then you hit your 50s and 60s and the resource flips. If you've done anything right at all, even imperfectly, money is at least somewhat built. But time is suddenly a real constraint. Yet most people keep making decisions as if time is infinite. That's why you see men who've done everything right still showing up at a job they're tired of because they want to squeeze out a little more safety. But safety is not a feeling you can buy. It's a system you build. Now you're asking yourself, okay, what system? Here's the first piece of honest advice for anyone working past 59. Stop thinking in terms of retirement age and start thinking in terms of retirement conditions. Age is a calendar number. Conditions are math. If you retire at 61, but your housing is paid, your spending is controlled, your healthcare gap is covered, and your investments are structured for withdrawals, you're more secure than the guy who works until 68 with no plan, no idea what his expenses really are, and a portfolio built for accumulation, not distribution. Distribution is a different sport. Most people's portfolios are built like a sports car. Go fast, take risk, beat benchmarks. Retirement is more like piloting a plane with one engine out. It's not about speed, it's about staying in the air. And this is where people make the mistake that looks smart, but is actually expensive. They say, I'll just work a little longer so I don't have to touch my investments. Sounds responsible. But if the job is costing you your health, your relationships, and your best years, the cost is not financial, it's existential. Now, I'm not gonna give you the usual cliche advice, like follow your passion or just downsize. You've heard that 1,000 times. I'm gonna give you a framework that forces clarity. It's a 3-number framework. And if you're working past 59, you should know these 3 numbers like you know your own birthday. Number 1, your monthly baseline spend. Not your dream spend, not your once we travel more spend, your baseline. The amount it takes to keep your life running without panic. Number 2, your guaranteed income floor. That's Social Security, pension if you have one, annuity if you already bought one, any rental income that is truly reliable after costs, and anything else that shows up even if the stock market has a tantrum. And yes, timing matters. Delaying Social Security past full retirement age can increase the benefit by roughly 8% per year until 70, which can be a powerful lever if your health and cash flow allow it. Number 3, your gap. Baseline spend minus guaranteed income. That gap is what your portfolio has to cover. And the reason this is so powerful is because it separates not enough money from not enough confidence. Because confidence comes from knowing the gap, not from guessing. Let's do a concrete example with round numbers. Imagine your baseline spend is $5,000 a month. That's housing, food, insurance, basics, not luxury. $5,000. And imagine your guaranteed income floor is $3,000 a month. Maybe Social Security later, maybe a pension, maybe some combination. $3,000. Your gap is $2,000 a month. That's $24,000 a year. Now, here's the part people mess up. They look at their portfolio and say, I have $500,000. Is that enough? That's the wrong question. The right question is, what withdrawal rate turns my portfolio into a paycheck that covers the gap with high probability? If your gap is $24,000 a year and you want to be conservative, you might target something like a 4% withdrawal rate or even lower, depending on risk and flexibility. At 4%, to generate $24,000 a year, you need around $600,000 invested in a portfolio designed for withdrawals. If you have that, you're not guessing anymore. You're managing. But now you might think, Tom, markets aren't guaranteed. 4% isn't magic. What about sequence of returns risk? What about inflation? Exactly. That's why we're not done. That's the math everyone avoids, and it matters more after 59. Sequence of returns risk is the fancy phrase for something simple. If the market gets ugly early in your retirement, withdrawals hurt more because you're pulling money out when prices are down. It's like trying to fill a bucket with holes while someone is pouring water out at the same time. Early losses plus withdrawals can create a spiral. So the question becomes, how do you work past 59 without letting that risk trap you into working forever? This is where it gets really interesting, because the answer is not work longer. The answer is structure. One of the most underrated moves is building what I call a bridge bucket. A bridge bucket is cash and short-term bonds and safe stuff that covers your first couple years of spending gap, so you're not forced to sell stocks after a crash. And before you roll your eyes and say, I know, keep cash, listen carefully. I'm not talking about stuffing money under a mattress. I'm talking about intentionally buying yourself time. Time is the real asset. If you can cover your gap for, say, 2 or 3 years without selling risky assets, you dramatically reduce the chance that a bad early market ruins your retirement. Now, the reason people don't do this is because it feels like wasting money. They see cash earning less than stocks and they panic about missing returns. But after 59, the game is not maximizing returns. The game is minimizing catastrophic outcomes. This is the difference between a rich retirement and a free retirement. A rich retirement chases the highest number. A free retirement protects the ability to stop. Now, another shocking stat that most people don't internalize: a huge percentage of retirees die with most of their money still intact. Not because they were geniuses, because they were scared. There are multiple studies showing many retirees spend far less than financial models predict. The average retiree often doesn't run out. They underspend, they hoard, they protect, and they do it because fear doesn't retire just because you quit your job. So if you're working past 59 because you're scared you'll run out, there's a decent chance you are about to trade your best years for money you won't even spend. That's not responsible. That's tragic. And the tragedy isn't just personal, it's structural. Because who benefits when you keep working? Your employer benefits, because experienced workers often produce more value than they're paid, especially if you're loyal and you don't negotiate aggressively anymore. The tax system benefits, because your wages keep getting taxed. And the financial industry benefits, because the longer you keep accumulating, the longer they get to charge fees on a bigger pile. Let's talk about fees for a second, because this is the quiet leak that people never notice. A 1% fee sounds small. It sounds like nothing. People spend more than that on lunch, but 1% on a portfolio is not lunch money. It's a lifetime tax. If you have $500,000 invested, a 1% fee is $5,000 every year. Every year, forever. Not just when you buy something, not just when you sell, every single year. Now compound that. If that money could have grown at, say, 7% before fees, and you lose 1% of fees, you're not losing 1%. You're losing a huge chunk of the end result. Over a couple decades, that can mean hundreds of thousands of dollars. This is why institutions love the work longer narrative, because it keeps the asset base growing, and their fee is a percentage of the base. Now, you might be thinking, okay, Tom, are you saying I should retire early no matter what? Are you saying I should ignore risk? No, I'm saying you should stop outsourcing your clarity. Because if you don't know your gap, your fees, your withdrawal plan, your healthcare bridge, your tax structure, you are not making a decision. You are drifting. And drifting is how you wake up at 66, still working, with no clear reason and no clear plan, just momentum. So let's talk about the hardest part, why people keep working even when they could stop. It's not just money, it's identity. For a lot of men, especially men who spent decades being useful, being productive, being the provider, retirement feels like becoming invisible. Nobody says that out loud because it sounds weak, but it's real. Work is a social role. It's structure. It's a scoreboard. It's a place where you know the rules. Retirement is open-ended. No deadlines, no performance reviews, no good job from your boss, and that openness can feel like falling. So some people unconsciously create a financial excuse to avoid the emotional work of redefining themselves. They say, I can't retire yet. But what they mean is, I don't know who I am without this. Great. Now, I'm not a therapist, but I can tell you what I've seen. The people who retire well are not just financially prepared. They are psychologically prepared. They have a plan for their days, not just their dollars. But here's the catch. You don't need a perfect vision. You need a direction, and you need permission. Permission you may never get from the world, because the world likes you working, so you have to give it to yourself. Okay, now let's go back to that factory story, because this is the pattern in its purest form. Let me set the scene. South Bend, Indiana, 1963, a cold morning. Men in work jackets walking into a plant that had been part of their lives for decades. The company was Studebaker, one of the oldest car makers in America. For years, the pitch to workers was simple. Show up, do your job, and the company will take care of you. A pension wasn't just a benefit, it was a promise. It was the reason you stayed when the work got hard. It was the reason you didn't jump to another job when you were younger. And for a long time, it seemed fine. Step 1. The company struggles, but the workers keep working. They accept the idea that loyalty will be rewarded. Step 2. Management makes decisions to survive in the short term, cost cuts, restructures, financial engineering, and the pension plan quietly becomes underfunded. Not by a cute little rounding error either. By some estimates, the gap between what was promised and what was actually set aside was on the order of tens of millions of dollars. Step 3. Because the pension is a future problem, it doesn't cause an immediate riot. People don't panic about problems that don't show up on next week's paycheck. But here's the catch. The pension isn't just a promise. It's a pool of money. And if the pool is smaller than the promises made, someone eventually has to eat the loss. Why would they do this? Because underfunding a pension is a way to borrow from the future without calling it debt. It's invisible debt. Step 4. The company's situation gets worse. Creditors tighten. Competition increases. Profits fall. And the pension shortfall becomes catastrophic. Then comes the crisis point. Studebaker shut down the plant. The pension plan could not pay what was promised. More than 4,000 workers, many of them older, many of them close to retirement, discovered that the guaranteed income they had been counting on was not guaranteed at all. And the emotional whiplash was fast. Not someday. Not maybe. Within days, people went from planning to panicking. Imagine the panic. Imagine being 60, thinking you have a pension, and then realizing you have a fraction of what you were promised. Imagine planning your entire future around a number, only to have the number ripped away because the system was underfunded. Some workers got partial benefits. Some got almost nothing. The younger ones were hit hardest because they were far from retirement and the plan didn't have enough to cover them. And the aftermath? The winners and losers were not who you'd expect if you believe the fairy tale of loyalty. Winners, creditors got paid before workers did. Executives often walked away with more protection than line workers. The system protected the people closest to power. Losers. The men who did the actual work were left with the loss. And the long-term consequence was so ugly that it helped push America to create new rules later, because the idea that pensions could evaporate was too politically explosive to ignore. And here's the kicker. The workers were not stupid. They weren't reckless. They weren't lazy. They did what society told them to do. They trusted the promise. They kept working. They delayed their own freedom because they believed the system would honor the deal. So what does this have to do with working past 59? Everything. Because the modern version of that pension promise is not a gold watch. It's the narrative that if you just keep working, you'll be safe. And just like that pension story, the safety is not actually in the promise. It's in the structure. If you don't build your own structure, you are trusting other people's incentives. And other people's incentives are not designed to maximize your freedom. They're designed to maximize their revenue. Now, let's make this painfully practical. If you are working past 59, you need to know which of these buckets you're in. Bucket 1, I genuinely need income to cover my baseline spend. Bucket 2, I could cover baseline spend, but I'm terrified of market risk. Bucket 3, I could cover baseline spend, but I don't know how to transition psychologically. Bucket 4, I'm working because I like it and it gives me meaning. Only bucket 4 is fine without changes. Buckets 1 through 3 require a plan. And most people think they're bucket 1 when they're actually bucket 2 or 3. This is where it gets really interesting because bucket 2 and 3 are solvable without sacrificing 5 more years. Bucket 2 is solved with risk design. Bucket 3 is solved with identity design. Let's handle bucket 2 with an everyday analogy, because people hear sequence risk and their brain shuts off. Imagine you own a house worth $300,000 and you have a mortgage of $150,000. You feel pretty solid. You have equity. Now, imagine you decide to renovate the kitchen, not because you need to, but because it will add value. You take out a home equity loan for $50,000. At first, everything feels great. You have a new kitchen. You feel proud. Friends come over and say, wow. But then the economy hits a rough patch. Housing prices drop by 20%. Your house is now worth $240,000. Your mortgage is still $150,000. Your home equity loan is still $50,000. You now owe $200,000 total. Your equity went from $150,000 to $40,000 fast. Nothing about your life changed day to day. You still live in the same house, but your financial position changed dramatically because you layered risk on top of a system without protecting the downside. That's what retiring without a bridge bucket looks like. You think you're fine because the market is up, you retire, you start withdrawals, and then a bad market hits early. And suddenly, your equity, your portfolio takes a double hit, falling prices plus withdrawals. Now you're forced to make decisions under stress. You sell at bad prices. You cut spending in ways that feel humiliating, or you run back to work, but now you're older and the job market is less forgiving. It's not the market drop that kills you. It's the timing. So the fix is not work longer. The fix is having the first few years of your gap covered by stable assets so the market can do what it does without forcing you to sell at the worst time. Now, I can already hear the objection. But Tom, cash earns nothing. Inflation will eat it. Yes, cash is not a long-term investment. It's an insurance policy. You don't complain that your homeowner's insurance only costs you money. You pay it because the downside is catastrophic. A bridge bucket is the same idea. And here's the psychological trick. Once you have that bridge, your brain stops screaming. Because your brain is not afraid of averages. Your brain is afraid of the first punch. Now, let's talk about bucket 1, the people who truly need the income. If you need the income, my advice is not just retire. My advice is stop trading time for dollars at the worst possible exchange rate. What do I mean? After 59, your marginal years of work should be evaluated like an investment. You're investing a year of life. What is the return? Most people never calculate the after-tax, after-expense return of working one more year. Let's do it. Say you earn $100,000 a year. Sounds great, but you don't keep $100,000. Taxes take a chunk. Payroll taxes take a chunk. Maybe state taxes. Maybe you're also paying for commuting, meals, stress spending, and time you can't use for your health. Maybe you keep roughly $70,000 after everything, maybe less. Now divide that by the time. A year of full-time work is roughly 2,000 hours of your life. That's not even counting commuting and the mental load. $70,000 divided by 2,000 hours is $35 an hour. But now you might think $35 an hour is good. Maybe. But this is where the real question shows up. What would that same time be worth if you use it to reduce expenses, increase health, and reduce future medical risk? Because the older you get, the more your financial future is a health future. If you buy yourself 5 more years of income, but you sabotage your health, you might increase your future costs and reduce your future enjoyment. That's a terrible trade. So here's the honest advice. If you need income, you still need a plan to escape, not a plan to endure. That plan might include part-time work, consulting, switching to lower stress income, or designing your expenses so your gap shrinks. And the most underrated lever is not earning more, it's shrinking the gap. Because every $1,000 a month you remove from your baseline spend is the equivalent of hundreds of thousands of dollars you no longer need to save. This is where people get stubborn. They say, I'm not changing my lifestyle. Okay, but then you're choosing to buy that lifestyle with your healthiest years. That's the trade. Say it out loud. Now, another big objection. Tom, but healthcare. I can't retire because I need employer insurance. This is real. And this is why I said retirement is about conditions, not age. If you retire before Medicare, you need a bridge plan for insurance. And many people don't even check what the real options are. They assume it's impossible, so they keep working. But there are marketplaces. There are subsidies in some income ranges. There are spouse plans. There are creative ways to structure income so you qualify for better pricing. I'm not giving you a one-size-fits-all solution because your state matters, your income matters, your health matters. But I am giving you the principle. Do not let an unknown become a permanent prison. Unknowns need research. Unknowns need quotes. Unknowns need numbers. And if you're working past 59 because you never got a real quote for your insurance options, you are literally trading years of life for a guess. Now, let's talk about the villain, because we need to name the thing that keeps the pattern alive. The villain is not the market. The villain is not retirement. The villain is not young people. The villain is not inflation. The villain is the fear economy. There's an entire industry built on convincing you that you are behind, that you are at risk, that you need more products, more complexity, more management, more insurance, more fees. And look, some products are useful. I'm not saying everything is a scam, but the incentives are real, and ignoring incentives is how adults get manipulated. Here's the motive. If you believe you are never safe, you will keep working, keep saving, keep accumulating. You will keep money inside accounts that generate fees for other people. If you believe retirement is risky and complicated, you will outsource decisions to experts, and those experts may get paid based on selling you something or managing your assets. If you believe you need twice as much to be okay, you will delay freedom and you will become the perfect customer. Now, how do they hide it? 3 tactics. Tactic 1, they talk in probabilities and jargon instead of trade-offs. They say things like Monte Carlo simulation and show you a chart that looks scientific, but they never translate it into what it means for your life. They never ask you, what would you change if the market dropped for 2 years? Because that question gives you power. Tactic 2, they anchor you to a lifestyle inflation number. They show you a retirement budget that includes everything you could possibly spend on. Then they tell you that's what you need. They blur the line between baseline and luxury because bigger budgets justify bigger asset targets and bigger assets justify bigger fees. Tactic 3, they focus your attention on market risk and hide fee risk. They scare you with headlines about crashes, but they rarely show you a simple chart of what 1% or 2% in fees does over decades. Because fee risk is certain, market risk is uncertain, and the certain thing is what pays them. This is where it gets really interesting. If you can reduce the fear, simplify the plan, and cut the invisible taxes like fees, you can often buy your retirement without earning another dollar. But now you might think, Tom, okay, even if I understand all that, what do I do today? Not theory, today. Good. Here's the immediate move. This is not basic. This is not make a budget. This is a tactical audit that takes 1 hour and can change your life. Today, open your retirement accounts, your 401k, your IRA, any brokerage account you plan to live on, and do a fee and concentration audit. You are looking for 4 things. 1, your all-in cost. That means the expense ratio of every fund you own, plus any advisor fee, plus any plan fee inside your employer plan. Add them up. If you don't know, that's the point. Find out. Because if you are paying 1.5% all in, you are on a treadmill. If you are paying 0.5% or less, you are at least not bleeding as much. 2, your concentration risk. Are you secretly heavily concentrated in your employer stock, or one sector, or one strategy? Many people think they're diversified because they own multiple funds, but those funds can overlap. If your top 10 holdings are basically the same across funds, you're not diversified. You're just wearing different labels. 3, your cash runway. How many months of baseline spend can you cover without selling stocks? Not how much cash you have total, how many months of the gap can you cover? If the answer is a couple weeks, you are exposed. If the answer is a couple years, you are protected. 4, your tax drag. Are you holding assets in the wrong place? Are you generating unnecessary taxable distributions? Are you going to get hit with required distributions later that push you into higher taxes? This matters because taxes are one of the few levers you can actually control. Now, once you have those 4, do one calculation. Calculate your 1 more year number. Take the amount you think you need before you can retire. Then subtract what you already have. That's the remaining pile you're chasing. Now, divide that by what you can realistically save per year if you keep working after taxes, after your real life costs. If the answer is 1 year, you're not stuck. You're close. If the answer is 5 years, you're making a 5-year bet with your health. And now comes the most important question. Is your plan actually 5 years? Or is it 5 years and then I'll still feel nervous? Because if you don't address the psychology, the finish line will move. So here's the empowerment piece that most people never hear. You don't retire when you hit a number. You retire when you hit a combination of number, structure, and mindset. Number, your gap is covered by a sustainable plan. Structure, you have a bridge for early market risk and healthcare. Mindset, you accept that perfect certainty does not exist. And you stop trying to buy certainty with years of your life. And I want to be candid. The goal is not to never be afraid. The goal is to stop letting fear write checks with your time. Now, remember the Studebaker workers. They kept working because they believed the promise would hold. Your version of that promise might be, if I just work 2 more years, I'll be safe. But you need to ask, safe from what? Safe from market volatility? Build a bridge bucket. Safe from healthcare costs? Get real quotes and structure your income. Safe from running out? Measure your gap and build flexibility. Safe from boredom? Build, meaning not just money. And safe from regret? That's the one nobody calculates. Because regret is the final tax. If you are 62 and you can retire with a reasonable plan, but you keep working because you want a little extra cushion, and then your health changes at 65, you didn't just lose money. You lost the only currency that matters, usable time. Look, I'm slightly frustrated when I see this, because it's not just a personal tragedy. It's a predictable outcome of a system that sells fear and calls it prudence. And I genuinely want you to win. So let me give you one final mental shift that might change how you see this. Most people think retirement is a cliff. Work ends, life begins, scary. But retirement is not a cliff. It's a glide path. You can reduce work without quitting completely. You can negotiate, you can consult, you can go part-time, you can create income streams that don't require your soul. And here's the secret. Sometimes the goal is not to stop working. It's to stop being trapped. If you choose to work at 61 because you enjoy it, that's power. If you work at 61 because you're terrified and confused, that's a cage. And the difference between power and a cage is a plan. So today, do the audit. Find your gap, find your runway, find your fees, find your concentration, and calculate your 1 more year number. Then have the hard conversation with yourself. Am I in bucket 1, 2, 3, or 4? And if you're in bucket 2 or 3, don't let 1 more year become a habit. Because a habit will steal your best weeks quietly, and you'll never get them back.